Thanks very much. I will say, Julie, this is a great event. It seems very well organized. Everything's going along very smoothly. I came up primarily to talk about the fixed income side of alternative investing. I will tell you that I come from a background that includes a lot of hedge fund work. When I was at Teachers and I first joined there, and I think it was 99, one of the first things they did was tell me that I had a $600 million hedge fund portfolio to oversee, and had a very steep learning curve on getting through it. The biggest problem I always had in hedge funds was the lack of transparency. So I'm going to kind of go through with a focus on how I look at the fixed income side and how I look for transparency a bit in the background, more as an example of how we do it, but really also focusing on the case for alternative assets in the fixed income space. And I'm going to go through a little bit about why it's important to drill into on fixed income. But I would start out with a focus on kind of the traditional story of how I like to put a presentation together, which is really what is the problem that I think we're addressing, and then what are the normal solutions and what is my solution. So that's the mode of this short talk I'm doing. The number one problem I see is that interest rates are very low. People have talked about it, everybody knows about it, but there's a whole slew of reasons that come out of that. But the big issue here is that interest rates are low, driving us to make decisions that maybe are not normal or non-traditional decisions. And at the same time, the problem too is you can't avoid the major characteristics of fixed income as an investment advisor. You need principal protection. You need diversification from the other things in your portfolio, whether it's equities or real estate. You need things that provide a diversifier, because there's no sector that consistently has stellar performance. And you have to have those things that modify the volatility. So the normal solution is to switch into kind of quasi-equity, I would say. And we're in this weird market right now where people are looking to fixed income for capital gains. And they look to, because there's no income, why invest in fixed income assets at all? It's because yields are all going negative, we're going to make capital gains. But on the flip side, they go to equities for income. It's a very strange world. That being said, there's a lot of alternative income strategies that come with additional risks, and I'll jump into it. The Cortland solution is a very unique one. I don't think many of you have seen anything quite like this. We do short-term private debt. I would suggest to you it's the financial component of the business-to-business supply chain. So we provide capital that manages that for small to medium-sized corporations, but it's actually a huge sector that's not very well covered by the banks and not well covered by alternative financial providers such as factors and things like that. So just kind of a quick follow up on the steps in this presentation. We're really zeroing in on why is this low interest rate such a problem. It's a massive issue for anybody that looks to rely on their savings as the producer of income that's going to offset their need for cash flow when they're not working anymore. And you have this environment where the blue line is the proponent of the overall population that is 55 and older. These are the boomers. This is all of us. And we're going to sit here and worry about what we're going to do with our need to rely on our savings to support us in our retirement. And it's a big issue because the offset is that interest rates have been in a steep dive for a long time, as pointed out earlier. The other side is that there's not really, and this kind of goes to the flip side, is what are you going to do instead? There's all of the big gurus in the capital markets these days are telling us that growth is not there. You're not going to have, and Al-Arian, the top one, Mohammed Al-Arian, who has said that not only is the growth model for the advanced world getting exhausted by the constant liquidity provided by quantitative easing, but he's also stood up and, at the same event in the Business Insider afterwards did a question and answer period and said, I don't think equity markets are going to see returns above 5% for the next 5 years or more, annualized returns. So you're not getting 5% on equities, and Mr. Pilasaw's presentation said that they're targeting 4% return over inflation and costs. That's a hard nut to hit. So you have this challenge that it's tough to make it on the equity side. The head of the IMF has stood up and said that downside risks are much higher than a lot of people are thinking about, and certainly higher than they have been in the past. And the last point by my favorite economist in Canada, David Rosenberg, is that while the economy is not in recession, profits are. And he's another person that has stood up and said expect low returns on equities for the next 5 years. And if you look at the profits on the S&P 500 since 2009 had been steadily rising for the last year, we're seeing this decline in earnings per share that we haven't seen for a long time, while price earnings multiples are high. So it's a very challenging market for any of the major asset classes. I'm sorry that you can't get this chart, see that chart very well, but I really spent a long time trying to put together all the numbers that look at the number of times that the equity market is backed up. And it kind of goes to how you're going to manage risk. It's very difficult to avoid the need for diversification as an investment manager. I can tell you this, that teachers, we were never allowed to do anything in more than 10% in any one major risk category. I would suggest to you that our biggest concentration at teachers was based on years of work, but trying to identify the strongest risk-adjusted returns. And if you get asset allocations that are uncorrelated to each other, that each have high risk-adjusted returns, you outperform your index all the time. It's a very strong way of doing it, and that is the model that we built in the fixed income side. But the flip side is you've got to avoid the downside scenario. So what this is showing you is that if you look at the equity markets since 1928, there's been 20 periods when returns fell by more than 10%, and the average period by which it took for them to come back to wherever you broke even was 4.7 years. And the average drawdown from peak to trough was 31.6%. So it is very hard to recommend to clients that they have a large allocation beyond normal to equities when you have the severe downside risk associated with that. And I just point out to you that we all know this, but that is the highlight of the importance of diversification. The flip side is, what are you going to do? Well, a lot of people have gone to the alternative of corporate debt on the fixed income side. And they've really pushed into investment grade corporates. You'll hear a lot of managers, a lot of journalists talking about you should jump into short duration corporate bonds as a way of adding value for your clients. And I would highlight for you that we're just now, we have had a spike in corporate credit spreads that has pushed us above the long-term average, but all those credit spreads have recently fallen the last 4 or 5 months and are now getting back to the long-term average for corporate credit spreads. So jumping into corporate bonds, you have the additional volatility associated with that of high yield spreads, corporate credit spreads, the risk premium that credits require. It's not a certainty that it's going to work for your portfolio. And the point here is that you have to be prepared to do this as a tactical allocation. Buying corporate bonds when credit spreads are very narrow is going to be a mistake and a costly part of your portfolio. So you must have a tactical approach, as compared to what the traditional allocators will say is that you should have a long-term strategic allocation. That is true, but the tactical portion of that has to be much larger and must be more aggressively followed by the advisors. The other thing that a lot of people have done is they've gone to these quasi-income strategies in the equity space. So they've looked to REITs and preferred shares as a source of income. The preferred share line is the blue line. I think a lot of people know about this. It's been a very, very tough area. I'm not sure that it's all because of bank-related preferred shares with all the rate resets that there are associated with them. Part of the problem is also the lack of liquidity. If you're a large holder of these securities and you decide that you would like to unload some of them to reduce your exposure, it is a very difficult market to work with. To the point that the regulators have reduced the major dealers' ability to hold senior large principal positions. That is a very scary thing when you tell them that they're not allowed to do that, because all of the investment dealers that are providing you with the other side of that trade must go out and find the bid from somebody else before they can buy it themselves from you. So the intermediation role is a much longer term one in terms of the transactions that it supports, and it is a potentially very costly one. Even REITs, the gold line, have gone through probably a source of a lot more volatility than people had expected. So all of these instruments are becoming tools that you can use occasionally. Maybe preferreds are a good buy now, but it has to be a tactical allocation for you. The issues, I think, are just come down to the basic ones for investors, that you've got a lot of concern for what are you going to do about your retirement security. You've got a lot of uncertainty about income, and you have to worry about inflation. It's not an issue right now for a lot of people at 2% target, but the central banks flooding the system with cash for the last 5 years has some probability that it will become an issue. You've seen recently some short-term spurts in 3-month quarter-over-quarter inflation numbers and 6-month semi-annual over semi-annual numbers. So inflation is not zero risk for investors. At the same time, being able to withdraw capital from your nest egg is not going to be a pleasant thing, and if you have to do it after a 20% downturn in the equity side, it's not going to be an enjoyable experience for your investors. The Cortland strategy is a little different. It's one of the few real absolute return strategies that I'm seeing, and we're very proud of it, but I highlight for you the dark blue bars are our performance monthly for the last 2.5 years. The gold bar is the XBB ETF total return month-over-month results. It shows a 70% return in January of last year. In that month, the monthly return for the XBB ETF was, I think it was 5.7%. And you do 1 plus that rate to the power of 12, you'll get to 70% annualized rate for that number. And it shows that fixed income has had some good wins and maybe some not so good wins. But the key is, in my view, is the level of volatility that we're targeting. So ours is 0.28% on average over the last 32 months. So that's the strategy that we're bringing, and I'm going to quickly go to how do we do it in just a second, but it does lend itself to a very strong Sharpe ratio. We used to look at Sharpe ratios for a good equity manager in the 0.4 to 0.6 range. On average, those for fixed income might be a little higher, 0.8 to 1. A good hedge fund manager has to get on in my portfolio. Teachers had to have a Sharpe ratio of 1, and we would get to 2 and we would really want to drill in because we didn't consider it sustainable. And the Cortland model is 16.9. It's a very, very reliable source of investment return and unusually high. And how do we do that? I did throw a lot of information in here. I don't have a lot of names on this. We have a small amount of high yield in the portfolio, about 1%. A small amount of mortgage investment corps. These are names that you would all know, about 5%. It is very important that we have those from one reason, and that is that in order to be an investment fund, you can't do strictly private debt under the OSC model. But the majority of our assets, 90% of them, are private debt. It's very short term. What we do is we focus on borrowers that will be repeat borrowers, because our average term is 45 days or less. So we need these guys to come back over and over and over again and borrow money on a consistent basis, so we're not chewing through a lot of our human resource capacity, if you will, at doing credit adjudication. We spend a lot of time validating the loans every 45 days, and we roll about 20% of them every week, so it's not a huge amount of cash flow, but we spend a lot of time on our portfolio that way. You'll notice that we do a lot of things like temporary staff, where Rogers might be the biggest end obligor, but a temporary staffing firm pays its employees every 2 weeks, and they bill Rogers for the services they provide at month end, but Rogers doesn't pay them for 45 days. And they'll sell us that receivable. So it's kind of like factoring that way. We have a bunch of tools that make it quite a bit different, with a lot more recourse to the originator. But that's the background on what Cortland does. I just wanted to put it out there so you have some picture on what we're doing, and how we, what is the story behind this strategy. But it is very unique, and I think an ideal one, and it's the kind of thing you should look for in the hedge fund space. It's very strong risk-adjusted returns and strong diversification from anything else. On that note, I'll end my portion of the presentation, and I'm here after for questions. Thank you.
Thanks, Pierre. Sean?
Sure, we can just go this one. So Sean Rogister, I'm at Cortland Credit Group. We do a short-term private debt strategy. I call it supply chain finance. It's the business-to-business supply chain in small to medium-sized corporations in North America. We have probably a Canadian focus right now, but it is North American wide in its application. The strategy is very much I think in my view, a great source of diversification. It's also very, very well principal protected. So it brings in some decent income. We don't promise the world, but it's kind of inflation plus 4%. So it brings in three of the major characteristics of that a fixed income product should have. Should have principal protection, should have income, should have diversification. And it should also be provide liquidity in the portfolio. And it's the one thing with our fund that we don't do exceptionally well. We give you 45-day liquidity because our assets are 45 days. It's much better than private equity. It's much better than a lot of managers that do more, they'll look for 90-day to 1-year securities in their portfolio and they'll promise 45-day. Ours is actually 45-day liquidity. But that being said, it's not daily liquidity because it's private debt. And I think on that side, it is a matched liquidity, but it's a significant diversifier because private debt is something that is very difficult for the average investor to do. And even at Teachers, we struggled with doing this initially. It took us a while before we built the capability to do it. It wasn't there when I got there, and we built it up to about a third of the portfolio, but it is it's something that is a challenge for a lot of investors to get their head around how to do it, and you really need to understand what your manager is doing in order to do it. So that skill of originating the assets is something else we bring, and maybe a skill set that I also see across the panel, because everybody here has a unique way of sourcing assets that suit their model, but that's ours. The biggest challenge I see is access to information. So if you're trying to differentiate yourself as a high net worth individual or advisor to them, you can't be doing just traditional public securities. You got to have a better way of drilling in, finding value, and sourcing out where the real value-added component is in the investment portfolio you're trying to do. I can tell you that even for high net worth, even for small pension plans, it is very difficult to do private equity, for example. It is very difficult to do a lot of private debt. All of the private assets, venture capital can't be a significant part of your portfolio. It's very difficult to do those assets. So you have to have an area of expertise that you really drill into, and you add value through maximizing the alpha or the value added you get out of the areas that you really drill in. The Cortland strategy, similar to what Scott was saying, is a very narrowly focused one. We do the corner of your portfolio that you want to rely on through thick and thin. It's not going to be everything to all people. It is a pure fixed income strategy. It could be a core debt portfolio, and I would suggest to you that it could be 25% of a core debt portfolio, because you can't get reliability of income in too many places. And we're one of the very few things that has yields that will rise as for the portfolio with rising interest rates. So it's just hard to get those things. And you really need to have strategies that deliver key components to you that you need out of your investment portfolio. So for high net worth individuals, you're gonna have to do the research and find those things that do what you want and really drill in and spend the time to get to know how to capture. US hedge funds had a terrible year last year. Canadian hedge funds did much better. So overall, it's a hedge fund was always supposed to be one of those absolute return strategies that was there for managers, and it was really not absolute return last year at all. From the middle of 15 forward. The other side is we've seen significant changes in valuations without any significant drop in profitability, because it's really only been the last few months that we've seen profitability dropping, but you saw credit spreads in the US really balloon out from the middle of 14 on, and maybe they were catching the wave of commodity risk, but commodities have had a really rough ride in the last couple of years. So I guess I'm throwing out that there's a lot of areas that are traditional things that people lean to. The US is a bit more comfortable with the regulatory side of moving to hedge funds. It's as they are allowed to abdicate responsibility to advisors in the US or consultants in the US, where we're not allowed to. So you can't have anybody do the due diligence and make the recommendation. You got to do the work yourself in Canada. That's on the pension side. High net worth has never been that way. They're a little bit less regulated or not regulated. But that being said, it requires a lot of work to jump into this space, and they're kind of overloaded with information on new investment strategies all the time. They got a lot of work to do. How do you get through that? In order to become a better investor, you've got to have in my view, and I kind of said it earlier, so unfortunately I kind of have to reiterate, because you have to drill into areas that you have expertise and expand on that. And I would suggest to you that alternative assets are an excellent place to build your expertise, because you'll have a significant edge over all your competition. It's one of the few ways to add alpha these days. And if you don't add alpha, then you're stuck with the beta, which I think a lot of people have said, and I'm a big proponent of, that beta is going to be a very tough thing to rely on for the next couple of years. So finding areas of the alternative space that you can be an expert in would be a critical way to build your differentiating skill set as well. Our fees are 1.25% is operations and underwriting fees. We also charge a management fee. Separate from that, the underwriting and operations fee is, as I say, 1.25%. Management fee is 1%. Managing a portfolio that rolls every 45 days with, we have about 15 different investments in pools of assets right now, and of those investments, there's about a total across all of our portfolio, about 1,300 obligors. So we validate every single one of the direct investments, which is about 800 of those every over a 45-day period, and about 20% of them every week. So that requires checking of electronic signatures, checking of proof of delivery of goods, validating that they are what their Equifax or Dun & Bradstreet reports are. And I would, just as a side note, when you're looking at disclosure in the public markets, you get public disclosures so that everybody has information the same way at the same time, 45 days after quarter end and 90 days after year end. Ours is every time we invest, we check something on their recent payables. Usually Dun & Bradstreet and Equifax are weekly updates, so we have much better information through private markets in some ways than the public markets. So on that side, all of those things contribute to our operational or underwriting costs, and on top of that we have a management fee that I think is how you pay the manager. So that's ours.
I could jump in and say for 2016 we are seeing a lot of opportunity to expand into short-term consumer finance and warehouse facilities. We're seeing a lot of people that need to borrow funds on a committed basis but need aggregators. So we're doing some consumer finance right now where we take on positions at the beginning of the month, and then it's relieved on or we given to an aggregator at the month end who can only do things on a month end basis. We don't even hold the position past the first interest payment. So it's an interesting strategy. We're doing a lot more in solar panels and those related areas that we hadn't really expected to see the growth. And then we're also seeing a lot of diversification on other areas that are, I'm going to call it quasi-government guarantees, so road construction, 407 equipment and things like that, where the income is guaranteed by the province of Ontario, but it's somewhat of a second-tier relationship to those sovereign or state or provincial entities, but with the full guarantee behind them. So on our side, it's an expanding area for us, and I think it's going to go. It's got significant scale available to us through it.